All right, guys, good afternoon. Part 3 of a 3-part webinar series, Understanding Why. And part 3 is the practical application. I'm going to walk through some trades from today, not from 2 weeks ago or even yesterday, because they happen every day. And I host a trading room every day, and we analyze and go through different direction. And all of it based on, when I say different direction, bias, execution, where you're in trouble, where to be careful, and we'll go through that one by one. So I'm glad everybody made it. I told this story the first 2 days. I didn't plan on telling it after the first one, but I'm going to tell it the third day. And it's this crazy umbrella and sunscreen salesman that's trying to figure out if it's going to rain or be sunny on Thursday, today, this morning. And he thinks he's smart, and he gets all this data, 50 years, that on Thursday, January 14th, it rains 80% of the time. Then he says that's not enough. So he digs a little deeper and he finds some data that says if it's rainy on Tuesday and Wednesday, on that third day, it's another 80% sunny. He's got it. Loads up his truck with sunscreen because it's going to be sunny. Why wouldn't it be? Look at all this data he's got. The poor bastard is in the rain all day. How could this happen? Instead of looking out to the westward sky and seeing that it was cloudy with thunderstorms, that morning, he tried to work harder to find less information as to how to predict the weather. The moral of the story the last 2 days is data doesn't make it rain, clouds do. And predicting rain has to be based on fundamental factors that make clouds. How do you tie that into trading? Data doesn't predict why price moves. OPP, which stands for other people's positions, do. People stuck long, stuck short. People shook out. The main reason, that's it, that makes price move. And so when I told this story the last couple of days, made me think. One thing I wanted to add to this story I didn't add in the last 2 parts was it's not as easy to look out the window in trading to compare it to see if it's raining. You look out in the westward sky, it's cloudy. If there's thunder, so it's probably going to rain in 10 minutes. It's not as obvious to people who get into trading to just look out into the westward sky or call your friend that lives 10 miles west. Is it raining by you? So the point is, how do I find that parallel to looking out west? Today, what we're going to do is tie it all together. Part 1, we talked how versus why. Part 2, yesterday, begin at the end, which is content versus concept. Today, the application with some examples from today's trade. In part 1, it was the whole concept, after you buy it, you're a seller. That's what moves price, not all the data that you get frustrated with. And then on Wednesday, yesterday, start with the goal in mind. Anytime you get in the car to go somewhere, you know where you're going, don't you? And a lot of people don't have the goal, or if they do, it's the improper goal. We covered that yesterday. So it's really important. The destination equals the goal. And a lot of people, when they just get into a little bit of education, it doesn't have to be the whole education of trading and everything else, but just like a little concept or a little, maybe how to read, let's say order flow, that's too general. But whatever you're looking to learn, like in my course, step 1, what do you expect to learn? What should you expect to be able to do at the end of it? That's a goal. And it's a proper goal because it's not the content. Too many people have the content as the goal. So let's roll into what, in a little detail, the targets for this afternoon. We talked yesterday, 2 days, why markets move. Understanding trading by design was yesterday, kind of the bridge to take what's important and make it applicable. So examples that you could use now or start using, obviously, tomorrow. All right. The whole Monday morning test, people go to a weekend seminar. What can I use on Monday morning? That stuff. But skills you could do right away. And then all of these things in a couple trades and scenarios that played out this morning and late this morning. Bias creation, qualification, pulling the trigger, treat your trading like a business, and where psychology could help. I'll talk about what we added to really make this and nail the Edge Trading Group down as a virtual prop firm. And then there's a special offer for people that have come here. I want you guys to pull out some paper. Some of you do it, some of you won't. Pull something out and write down steps 1 to 5 on the left-hand side. Leave it blank. Just write 1, 2, 3, 4, 5. Because today I want you to write along with me what your step 1 might be. What makes you, if it was ready, aim, fire, what's your ready, what's your aim, what's your fire? What's your step 1, what's your step 2, what's your step 3 in executing a trade? So just write on a piece of paper, kind of like you see on the screen. And get into, you got to have an opinion. Are you bullish or bearish? Now, let me say that again, because you don't always have to have an opinion. But step 1's always going to start with an opinion. Are you bullish or are you bearish? You got to qualify it, or in other words, aim, sit up. What makes you sit up in your chair? What makes you pull the trigger? What helps you manage your risk around it? And is there some psychology at the end of not the trade, but the day or the week or the month that's coaching? Because too often we look at psychology as what's going as the track. Psychology and coaching get you back on track. A guy told me a story. It's like a coach. He calls timeout. He doesn't get everybody together and has to explain the basics to them. He tries to reset and get them back to the basics. So when you think of psychology and trading psychology from now on, I want you to think of it as like a coach, not some sort of psychiatrist you have to go see in order to predict where price is going, because they tell you how markets move and we're going to tell you why. All right, so let's start with today. Let me pull a pen out. Today, to start the morning, we had a number come out, an economic number that was pretty big and watched because of this pandemic, and it was the weekly jobless claims number. And it came out at 965,000 unemployment benefits. Now, is that high? Well, it's what was expected to be. That's what makes it high or low. And it was a lot more, like 200,000 more than it was 750. So it was about 200,000 more than it was supposed to be. Now, I'm saying this because it was a number that people are kind of interested in. And it was a bearish number for stocks. It was bad for the economy. Generally, stocks will go down. Stocks barely moved lower when this number at 7:30 Central came out, an hour before the open. So that got me to scratch my head and be a little bullish. So again, what's driving the market? Is anything driving the market? So you get a weak number, that real weak number, and stocks can't break. All right, maybe some underlying strength. Then another driver is the new Biden administration is talking about another $2 trillion stimulus or COVID spending bill. And I don't care what you think politically, the markets are like spoiled brats. They love candy. So more stimulus better, at least in the short term. So that might be the reason for this underlying strength. So I came in with a bullish bias for today. So that was my step 1, and it's what step 1 is in the program we laid out. And I'm going to say this again in another slide, but the program that's been redesigned and laid out fits into the same progression you would have to put a trade on and take a trade out. It's laid out in those steps, and I'll show you when we get to it in a second. So that's step 1. I was a little bullish. Let me bring over the, let's see, is this it? Yeah, the recording. And let's go full screen. This is a recording from today's trading room. And these are the charts that we use. Now, I'm not in this webinar want to get into the minutia and what's this, what's that, what's that, what's this. You can have those questions, but forget about for that for a second. Just listen to the progression of what I'm going to explain step by step. Don't get confused and don't look at any shiny objects. Just focus on mostly this part of the screen share right now in here. Okay. Down in here. This is footprint. Forget about what rotation it is, what periodicity. The market's going back and forth like this. That's the rotation that the market is showing you. Worry about the numbers. In fact, when I rendered this video, it first was blurry before YouTube made it high definition. And you know what I said? Good, I'd rather it be blurry. I don't want people looking at the numbers, but it's in HD, so we'll go with it. Now, a little bit after 8:30 Central, after we opened. Remember what I said? I had a little bit of a bullish bias, right? I had gotten long because I seen a big seller come in, and you could kind of see it with a big red rectangle. However, two things happened once I got long. It wasn't going up, and a big buyer came in. I don't want to see a big buyer when I'm long, unless the big buyer comes in and it goes up right away. And we'll kind of get into that as we walk through some of these other setups. So I'm not comfortable with it, even though it's not against me. All right. So when people say, well, where are you going to get out? Might be where the heck I got in if I'm not comfortable. Well, what makes you not comfortable? I'm long and a big buyer comes in and it doesn't go up. Anything else? Yeah. The NASDAQ over here, which is this chart, if you follow my cursor, took off and ran up to 04 from 94, 10-point rally in the NASDAQ. And we didn't budge higher. So in the room, and guys that are in the room heard this, before we went lower in here, I got out and I told people in here, be careful being long. Why? Big buyer, we can't go up. And the NASDAQ just jumped 10 handles and we couldn't rally. And by the way, that's step 2 and step 3 in the program. What creates your bias is step 1. Step 2 is order flow and market relationships. And step 3 is what makes you pull the trigger. What makes me pull the trigger is a big seller. We couldn't go down. This particular trade. Where's your risk? Where's your stop? Stop is generally, at first a couple ticks below the bottom of a range, but that's not where it stays. And that's what I want to get people off is arbitrary, how many ticks below the recent swing low to put a stop to get out of a long. Forget about that. Yes, you should have stops, and yes, you should manage your risk, and that's all important, and that's covered in our step 4. But make sure you understand, don't take your eye off the enemy. You're still looking at good information. So this gets me out of a loser, and it does two things. It gets me out of a trade that would have been a loser, and it would have prevented me to probably get back in when there was a better qualifier to still get long. And let me roll through that as I play it forward. And once in a while, you're going to see illustrations. That's not me illustrating now. That was me illustrating in the room that I was recording. And you could see the yellow line that just went up on the right side. That's me telling people, hey, we just ran up in the NASDAQ and we had, prior to here, and we just had all this big buyer couldn't go up. Be careful long. And then it goes down. Now, let me stop it a second because a couple things happened that you wouldn't have seen unless I point them out. And don't worry about what every single one of these vertical lines are. Are they delta profile? Is it volume? Forget about that. Just I'll walk it through. When I explain it, then it's important. And I'm not saying that in a condescending way, but you're not going to hear this from anyone else that's out there. And because that's what I've been told. You explain it different than anybody else does. So maybe those people are wrong, but do a search and see if there are people that are explaining why prices move. Here on the far right side, in this vertical, are identifying where sell stops are. Like we talked about in our first webinar this week, it's important to know if there's sell stops, longs are puking. If I want to get long, I don't want a lot of longs with me. So if I know longs just got shook out of the tree, that's better. Let me rewind it a second. Right to there. Now, big seller comes in and a bunch of sell stops, or longs puke. Longs who are not longs are not sellers. There's less sellers, better chance to go up. Now, I don't just come in and buy it, but I want to get long above where I think this red seller could be stuck. And it's not just him, not just that order, but it's indicative of how everybody else learns to trade. Big selling, sell it. No, big seller, look at the reaction to the market and maybe buy it. And this is step 2 of the program and of the course. So a big seller comes in, which is this red box. This green line is a buy iceberg, which means, again, when I see it becomes a quick pivot for me, if I'm bullish in this case, and I see it get above this red block, big seller, and across back above where this iceberg came in, I think I got the people who sold the iceberg, if it gets above it now, stuck short, turning to buyers. And this big seller didn't move the market down. And why is it back above it? And then what? Longs puke. So when you couple all those things together, you start to understand objectively where good spots are. And this is every day. This is every day that we look at this and we analyze it. Bullish, bearish, qualification, disqualification, pull the trigger. I missed it. I caught it. Now, I might get questions, and I'm not looking at the chat right now, but I might get questions. Let me stop it a second. I might get questions that say, where would you get out? Where's your stop? If your stop that you put in never changes, then it's the wrong question. Your initial stop shouldn't be your average stop loss. You, first of all, don't want to put in a sell stop where everybody else in the world are putting in sell stops. So initially, on a trade like this, I'm looking for it not to go below where this swing low is, or this little rotation low was. But you know what? I don't want to see it get much below this red seller. I want to see it have a reaction like this. So for those that have that question, where's your stop? I'm not saying it's an awful question, but it is if that's your first question. Your job is to worry about where other people's stops are, not yours for now. And we talk about risk management in step 4 and the proper placement of stops and things like that. But what's important to know is if I buy it here, I'm not risking an indefinite amount of money. I'm looking to see if what got me in changes. What do you mean, Anthony? Well, look what just happened once it rallied. You see this purple box? That's a big buyer. It rallies 2.5 points out of the hole, which is 10, 12 ticks at this point. It's probably more than 3 points. And if a big buyer comes in and you're wondering, where should my target be? And your target is a tick above this big buyer, you just were told, hey, maybe you just get out right here. So you don't just seem like you're sitting on the railroad tracks with your stops and your targets. And this isn't rocket science. Understanding it is where the skill is. But big buyer, I'm long. Should I get out? If you're scaling, you're damn right you should get out with the scale. Because part of trading, and this is part of the step 4 and risk management part of the course, is managing your risk by managing yourself. So as you walk through this particular trade, you want to avoid letting nice head starts turn into losers. What's the worst thing, and it didn't happen in this particular trade, the worst thing in trading is you get 2-point head starts and you let 8, 10, 12 tick winners turn into full stops. That's taking your eye off the enemy. That's blinding yourself to the information you should still be reading. But just ready, aim, fire. Already bullish because I'm looking for underlying strength in this market out of the gate. They just shook out probably a bunch of longs that were in here, down in here with what I showed you with sell stops that came out with this green. All right. Sell stops, longs puke, got above this iceberg, take a shot, and the market walks up. Now to another scenario. I'll go back and answer questions to this if there are any. I'm just looking to see. Someone says my voice gets blurry. Has the sound been okay for everybody else? No, this is not a set. The setup is not Sierra charts. The tool. This is the tools, but we use Sierra as the visual. I'll get into that later. Sound is okay. All right, good. Someone said it was blurry, but all right. Let's move ahead to 113. 42. Again, your questions, I'll go back to. Now, right in here, I'm looking at this market still bullish in this scenario. I'm looking for this market to blast through the top of this range. In fact, I probably even draw a yellow line in the room. But something had happened that disqualified me trying to play this breakout. What do you think it was? And it just happened. Let me scrub it backwards a little bit. I like that word. Scrub it backwards. Right there. A big buyer comes in. After this big buyer, we're having trouble going up. Now, I'm not bearish looking to get short. If I was bearish for another reason, I might, but it's disqualifying for me to get in. If it goes up, great. But I'm trying to make sure I've got more buyers if I'm long, not less. And if big buying comes in and we can't go up, you might be staking other longs that are looking for the same thing. So as we play this, something really interesting happens and it pretty much falls out of bed. There's the yellow line I drew in the room and said, I want to play this thing to test the overnight highs. I'm still bullish in the underlying strength from a real weak jobless claims number coming in, but I'm not doing it because of this big buyer. And that illustration is what I'm talking about in the room as it's happening. So in this case, it did save me from a loser. Now let's scrub ahead a little bit because this was a pretty big. How many people remember this move this morning at around 9:30 Central? I'm going to fast forward. Going fast. Now, watch a couple things happen. You see the red box is a big seller, right? He gets it to go lower. This big seller gets it to go lower. Those are things you want to get the hell out of the way for if you're looking to qualify long. Big selling is getting the market to do what it's supposed to do. This big buyer didn't get it to go up, and it kept me from wearing it and taking a loser. So I'm illustrating in the room all of that, talking about the big sellers getting the market to go their way. Okay, that's why you see two cursors, by the way, two arrows. Now something interesting happens right there. Do you guys see it? Let me pause it. I got to get something on Zoom out of my way. It's blocking my view. All right, it's even worse now. Let me put it up there. Okay. Bottom of my screen, Zoom has a panel. You guys don't see it, but I see it. All right, see down here? Big seller gets the market to go down. Big seller and an iceberg appears. Let's play it. They go through them. No, he actually gets highlighted as an iceberg and moves it lower. Now, this got me to change my bias, which is in step one. What creates a bias? What could get you to change your bias? I go, let me pause it, from bullish to bearish. Where would you'd say where? Well, probably when I seen this seller get it to go. All right. Number two, when I seen this seller get it to go, this seller get it to go, and I seen this iceberg move it down, there's two things. Generally, they move away from it, but I'm going to be bearish for a little bit because he's a magnet. I talk more about that in I think it's step two in the course. It is. Step two talks a little bit more about icebergs and why they're a magnet. But just stay with me on that. So all this information comes in, right? We start getting hit. Big seller, drives it lower. Iceberg gets filled, but then gets dropped. He's not only got 500, maybe hard for some of you guys to see, but he's already down 500 and he's showing 100, which is a lot to show, which means he's probably got a lot more. He's a resting bid that has a lot more than meets the eye. That's what an iceberg is. I don't want to get into a full definition of an iceberg. More than meets the eye. So let's play it. So I'm not short, but I'm bearish now. And I changed my opinion as I watch you through this progression. Now we bounce. Now, some people could come in and buy if they want to buy off this iceberg because you think that's fine. I didn't do it. Now, what happens is I'm doing a little illustration and going back. A couple guys in the room caught this. I missed it. I wanted to get short, not just by price, but I told guys in the room, this red seller here is going to be rotational resistance. Which means the market, follow my cursor, is going to come down and rotate up to where he came in. Let me stop it. That's not enough to get you short, though. You turn from bullish to bearish, or at least I did. You see an iceberg come in and he's a magnet. You see where it could go up as rotational resistance. Still not enough, but you see a big buyer that came in and right away the market laughed at him. Let me go backwards a couple beats here. Right there. Right there. See him? That's your when moment. Now, I missed it. Some guys in the room got it, and it happens. I don't get pissed and start throwing things around because it ain't the last trade I'm going to miss. And you have to trick your mind. When there's a trade you're supposed to catch, you got to pretend like you caught it so you don't do something stupid next. That's part of the psychology and coaching that'll help you in step 5. Trick your mind as if you caught it so you don't do something next that's stupid, like sell it late. It's okay to miss trades. It's not okay to keep missing trades. That's, again, the coaching in the step 5 portion of the program. Now, if I play it, go forward, you could see the market react as soon as the buyer came in, couldn't go up. You're anticipating this. You're looking for this. Now, the one particular guy that was short was Dave in our room, and he sees something down in here and says, I'm out. I didn't have to say why, but we went over it. Oh, I got to play it. But I went over it with guys, and I want to go over it with you guys. Take a look at this. So the magnet is this iceberg, that green line. Watch what happens as the market rotates up right here. Big buyer gets stuck. He came into the big buyer gets stuck, starts heading back south, is going to try to attack this big order. He's done 500. Look what happened. See that white line that came in? Let me pause it. That white line that came in is a resting sell order, a limit sell order for 511. The guy's on the track saying, hey, guys, I'm selling 500. Paul, there's a couple other guys from the floor. Guy comes in and yells 500. What price was he offering? I think 90 half. I mean, 950, 9 quarter. He's a resting sell order with pretty big size. The conventional wisdom would be, if you just learn how to trade, big seller, sell it. No, big seller, we go get it. Be careful being short because there's an appetite for buying. Another thing happened. Take a look down here. Right there. See where my cursor is? Right into that iceberg, a big seller comes in. If you're bullish, which at this time I'm not, I'm going to try to buy it when I see that. Certainly through the white offer, but I wasn't bullish. If you're short, and like I said, I miss getting short up here, but if you're short, this is the trigger to get you out. So someone who says after they get short up here, Anthony, I'm looking for 9 ticks, I didn't get filled and only went 8. And then the market rallied all the way up to here. It's because you're taking your eye off the enemy. Or someone that says, I risk 3 ticks, so I've got to make 6. You think the market cares about that? So this is step 3 and 4 of the program, where what gets you in, but managing your risk, what could get you out in real time without being arbitrary with a sell stop 4 ticks away. Therefore, my reward's got to be 8. And this isn't, like I said, rocket science. I'm not oversimplifying it, but I'm saying if you're not following this progression, everything else is like the umbrella salesman looking at 50 years of data. So let's play it. Market rallies through. First, he gets stuck. I mean, this big seller couldn't get it through this 500 lot. Right now, he's up to 726 totally bought. It starts to scoot through this white big offer. Not scoot through it. They gobble them up like that. Paul, you remember being on the floor. What would the sound? What would the audio be in the floor? Be a roar when they jump through that 500 lot. When there's an appetite for buying like that, that means look out above, at least temporarily. At least temporarily. Let's fast forward. Now take a look at this. A red iceberg comes in. Again, if they get through him, more appetite for buying. It already slid through. You could see my cursor. That's my cursor in the room. They already got through him, and now it gets through the red. It's like, oh, should I have gotten out? You should have been out. Now, I'm still slightly bearish. I'm still, for a couple reasons now. You see this green iceberg? He's still a magnet. It's temporary pop based on the analysis down in here. But halfway up, including that red big sell order I'm showing, is to me an area I want to get short, looking for a test of this iceberg because he's a magnet. Something happens, and you could see my cursor flapping around in the room, that again disqualified a short that would have been a loser. You know what it was? Forget about all the gray noise that you see in there. Focus on the purple, which are buy boxes, red, which are sell boxes, and the white and green lines. Right there. There was a red seller here. So I wasn't going to do it. Another red seller, and this guy didn't even budge the market lower. Didn't even budge it lower. So I thought to myself, well, if it's going to come up against this, here, I'm drawing the line right now in the room. If it's going to come against that red seller to sell it, that red big seller got my hand off the mouse. You got to blow zoom up. You'll be able to see it. You'll blow it up. You'll be able to, this isn't how you'd see it when you're trading it. Remember, when you're watching this, you guys don't have to see it as clear as if you're trading it because you're not trading it right now. You just got to pay attention to what my arrow is going to. And there's ways to blow zoom up so it's as big as it needs to be to see it. And I'll show you in the trading room how much clearer it is. Remember, this is a recording of a screen share. All right, so the market pops. This is another good disqualification of a bias that was wrong, but guess what? It's all about disqualifying and qualifying using why price moves. So you create a bias as to why price moves, step 1. You create a qualification in step 2 with why price moves. And then you pull the trigger in step 3 of the course with why price moves. You manage your risk with why price moves. And then you're getting coached with step 5, the psychology. Now, as we're going to roll through any of this, and I want to go through all this and then go back and answer questions. But keep it simple. Like I said at the beginning, don't go off looking to the top right. Don't look at these green lines and all this red and green, all this red and green. I'm not even looking at most of this stuff in real time. I reference it. There are key spots on this chart that I look at, and that's it. All of these lines, though, all of them have to do with orders and order flow. There's no Fibonacci or moving averages. The VWAP is the only mathematical thing on here. They're all orders, aggressive, passive, stops, big buyers, big sellers. All right, so this market, and I go over this in the room, rallies too much, too far back from this break. So I think to myself, I think there's a chance it could go up, but I'm not looking at getting long for a test of the overnight high. Why? Because that magnet's still down there, and he's done 700. He's showing 100. He might have 2,000 to do. He's a magnet. Why is he a magnet? I think it's step 3 that explains icebergs as magnets, because what do most people do? What do most people do when they see a big buyer down there? They want to buy it. Let's get long and lean on the iceberg. So if a lot of people get long, a lot of people are getting to be sellers, and it starts to become a self-fulfilling prophecy, and they get out back down to the reason that got them long in the first place. Does that make sense? We talked about it in part 1 of the room. In fact, here's what it looks like in the room. I'll bring the chart up, which is much clearer. And you can see an iceberg that's coming in live. Market's probably closed, though, right into the close. When people say if it's blurry through Zoom or anything else, it's through Zoom, and that's what it looks like in the room. So anyhow, you get into our next scenario. Like I said, because it went through and retraced this whole sell-off, normally would be bullish, but because that big iceberg is down there, I'm like a bear with horns right now. Neutral. So let's fast forward to 155. What do you say? 155? How many people are finding this interesting? Or getting the gist of it, I guess. It's making sense. Does it click? All right. All right. What did I say? 155? Everybody, or not everybody, but a lot of people, it seems to be clicking for. All right. 155. We have this scenario playing out. What scenario is that, Anthony? Let's back it up a little bit. Take a look at this whole picture. Now, this is my yellow illustration, not me in the room. This was that scenario I just walked you through, where you got short on the retracement. Tried to get short. I missed it. A couple guys in the room did. They wrote it down to part of the target. Seen the big seller come in, seen it get above that big offer. They covered, was the right move, and it went back to where it started. All right. Back where it started is generally resistance. Not necessarily bearish, but generally resistance. Okay. Well, remember what we have here is a magnet. So that does make me either less bullish or not bullish. If it's not going to make me bearish, it's going to make me disqualifying trying to get long in that area, because I have a good sense it's going to go down here. But I want to see more. All right. I want to see more. So now the market goes and actually gets hit. And they crack it pretty hard. I'm not here to tell you, hey, what's the matter with you in that yellow circle? You should be short for that. No, there was nothing necessarily that I could see to predict that. Don't try to predict every single move. It's impossible. But after that happens, and before this happens, you go back to you've got now a bias that could be bearish. After this drops, I am bearish. I think it's going to take out at some point that magnet, but you can't sell it. How many people sell it and they're in the hole and they get stopped out on a pullback to there? Or they sell it and they ride this heat and they have a little bit of a head start and then they ride it up here to get stopped out and then it goes back down. So you got to take it step by step. You see this thin spot? It's usually a thin spot because it went fast. That's a decent area of resistance in real time. Does it mean you could just sell it there when it comes up there? No. So what's going to happen is if you think you could just sell it across, sometimes you don't get filled and you're like, what am I doing wrong? You got to see something in here that could get you short. What do you see in there? You see a big iceberg that came in and they gave it to him right away. There was an appetite for selling. And the market drives down, right? That's noisy in here for a while, meaning noisy, it's choppy. Another thing I didn't add at the beginning of the day, I told everybody, listen, the volume is light coming into today, number one. Number two, the range in the overnight was tight. So that's all about the context, which is, step one of the whole, the program is what's the context in relationship to what you should expect. There's not a breathing exercise or a psychiatrist that's going to tell you when you should be more or less patient. It's, listen, you might have to wait a little bit longer and minimize your expectation because today's a little slower. So the market goes up to where you would expect it to stop. Again, keeping in mind the magnet. A magnet is the best word. It's better than a target. Because if you say target, it doesn't really pull in, when you say magnet, that's where it's going to go. Price is the metal and the iceberg's a magnet. Was there an opportunity? And at this point, I did not do it. But was there an opportunity to sell it when that big buying came in and they got underneath it? Yes. Well, where would your stop be, Anthony? Again, if that's like your first thought, it should be a thought. It shouldn't be your first stop anymore or first thought anymore. But let's play this out and scrub it ahead a little bit. $155. Well, I forgot to show you the shorts puking. Let's get this thing. All right. Big buyer come in, right? And just wait and watch. If I'm looking to get short, I don't want a lot of people short with me. I want the shorts to get shook off the tree. And then it has a better chance to go down. Big buyer comes in, still above it, but if it gets below it, longs might start to sweat. Longs that are sweaty are sellers. I don't feel like keep continuing to wait, but right in here where our buy stops are, light up. Buy stops get triggered, which are shorts puking, just creates the opportunity to go down. Remember part one of this webinar series? When shorts puke with a buy stop, there's less buyers below. Less buyers below, guess what? It's easier for the price of anything to go down. Where is it? I got to scrub. It might have been that little bump out of shorts that came out. It was before. This was a trade I did not take. Oh, here was some of the shorts puking. Then the big buy order came out, and underneath them created the path lower. I went too far ahead. 155 was too far ahead. But here's some of the shorts that are puking. Don't worry about these lines or that line or this line or this line or this line. Just focus here. Shorts puke when this red bar kicks out to the right. Same thing with this one. Tiny different variation of how we find the stops. Again, that's explained in step 3, I believe. All right, let's go to the next scenario. $212. $212.49. No, look how clean this is. Now, just hold on a second. What's already happened walking into this? Let me pause it. Here's our green iceberg. Remember, he came in way back over here. By the way, this chart above is just a different pair, or is just candlestick. So when you look at it here, it's like a magnifying glass down here. So when you look up here, you're looking at like 9:30. This iceberg came in, and now we're at probably like almost quarter to 11. 9:30, quarter to 11. So this market, and like I said, if it was a more volatile day, they would have done all this price action faster. So the fact that it's going down slow, if someone were to say, yeah, I don't think it's going to work, it's going down slow. Well, you got to expect it to go slow in the context of today. I get it. So if you're still bearish, but you didn't sell it like me up here, you have to know that you missed maybe a little bit better of a location. That doesn't mean you can't sell it because of anticipation of this going through. It just means that you got to know where you're at on the map as far as expectations. Does that make sense? So what happens here, let me scrub it back, is this iceberg actually moves lower right here. The market comes down, stops right in front of them, and now it's hovering above it. It's going to go through them. He moves it, this SOB, down a few points. Big buyer comes in. That's now bearish with an aim and fire, almost all mixed in together. Okay? All right, Kevin, you're welcome. So now we're moving, fast forwarding. So we're not too bored. Let's move it forward a little bit. This big buyer could have gotten you short, couldn't get it to go up. Once it got underneath it, it could have. Maybe you see it now. It doesn't go through it yet. Remember, because he lowered it. He lowered it. This big seller, if you're short, might get you out. So you don't have to take 2 more points of seeing less profits off the table. But it's no coincidence. Big seller comes in and it pops. But the magnet's still down there. 225. There's so many things I could show you with respect to example after example after example. But here's a pop, big buyer. If you're still bearish, and you should be, because the magnet's still below, and this red kicks out. What is that? Shorts puke. If it's red, shorts puke, big buyer, take a shot. You're bearish because of a green iceberg. You get a big buyer and it's starting to get underneath them, and you got shorts that puke. She let you buy her a drink. She says she'll go out with you. And she said, yes, I'll go in for a drink. What are you waiting for? And I say that as half a joke because you still got to manage your risk. And it's not oversimplistic. It's just the better aim and fire that anybody uses. And it's what's been missing in people when they try to learn to trade. What's worse, the worst thing about trading in the education that I've been doing isn't that people come and not everybody could succeed. It's that the people that didn't give themselves the proper chance to do it. $249. Let's fast forward to we get when we go and take him out. Couple interesting thing happen. Couple interesting things happen. Hey, what time is it? We're moving along pretty good. Hopefully, you guys are staying interested. I think you are based on the comments. And if you say, I never heard of this stuff out there, you're in the majority because everybody says that to me. I always took it for granted because, like I said, I had my from the floor and from the prop firm, right, Paul? This was governing principles that you knew when you got into the business. HK, good question. Give me a second and I'll get to it. All right, where am I at now? 249. Big buyer comes in. This, by the way, in case you're wondering, I know people are wondering what everything else means. This is just tracking if big buyers come in, make it easier to see. So a lot of aggressive buyers just got green because of that big buyer. Comes in, another win moment. You're waiting for the deer. Just because you see the deer doesn't mean you shoot, but now you got a shot, you take a shot. Now they're running pretty aggressively at this guy. However, right above him, a big seller comes in. Could that get you to scale and get out? Yeah, even if it keeps going down, maybe you take something off. Who cares if it keeps coming down? You're supposed to use what got you in to help get you out. Risk management, step 4. All right, let's scoot ahead. Scrub it forward. There are some days this scenario plays out much faster because it was busier that day. There's a lot more market action. Let's move up to I wrote the damn number wrong on my sheet here. 221. Why would I 221 and go backwards? Oh, right. And think about this for a second. If you got short because Anthony tells you it's going to fly through there, but you got short good and it goes down there, it doesn't fly through there, and you still got it and it's up in here, that ain't my fault. You were given the clue to get the heck out with that big seller and couldn't go lower. Are you still comfortable because it's staying below? Yeah, kind of. And guess what? He's still a magnet, so it's still going to go through him. I'm not saying that because I know it did. You guys had been in my room. How often are they magnets and it goes back down there? Almost every time. The skill is to finding the location to get in for it. You can't just, if the iceberg's below, you can't just sell it, go for a jog for 4 or 5 hours and come back. But just think about what I'm saying to you. There are people in the room that who's a regular in the group that's here today. I don't see everybody, but and this is just one of many. And people say, "Well, what's your setup?" It's not a setup. It's a step 1, step 2, step 3. It's a progression. Oh, that's why I had the wrong handle. It's 321. I'm either losing it or I lost it. 321. Now take a look at this. Let's go back a little bit. All right. I'm going to pause it. We're right on this iceberg. Let's say you didn't get short up here. Let's say you never got short and you're still thinking there's opportunity because we're going to go through it. All I'm going to tell you is still wait for the same step 2 or step 3 to qualify and pull the trigger, which are big buyers or big buying to push it through, but also know where you're at on the map. Know that this market knew about this iceberg way back in here and it's dropped 10 handles. All right. The market knows it dropped 10 handles. So the rubber band stretch, just realize that there might not be 10 more handles in the context of today. So don't sell it here thinking that you could be in the same location as you would be up in here using this as a magnet. Does that make sense? That's important to know. But you could still take a shot. And then right in here, there was a qualifier taking shot. Back to back buyers came in there and there. And this one, did you see how that guy came in and they cracked him right away? Boom, boom. So again, boom, comes in, boom, and they laugh at him. That's like when your friend goes to buy a girl a drink and she smacks him in the face. Rejection. It's a rejection of a buyer, rejection of a buyer. You've got the magnet that we're going to go through finally. You also had other shorts puke over there. So the market finally, I think this was the rotation that jammed through them. This is from today, by the way. Let's scrub ahead. So we get through them. I think he ended up doing 1,800 total. Now, a few things to notice. Like I said, we already came from 10 points higher. It's a slow day. Let's say you sold it and you're in here. We get through them. There's a support area that Dave and that we have a lot of times for the same reason. Support area for the right reasons, like stuck traders from a day or two ago. Not 50 years of data. No, stuck traders that maybe are short like baby birds hanging on down there. So we want to be careful of trying to press it through this zone. All right. You also want to be careful when it comes back across this iceberg. However, you want to make sure you're not still short if it gets above what got you short, and that's this big buyer. All right. Personally, me in this position, I'm out when it got back through this iceberg. And there happened to be more downside, but not much more. All right. Now, if I had more scales on, you'd maybe take a shot, get out of some there and see if there's any more left. But if I wasn't out of this short for that reason, I could tell you that when here's a big buyer. So, okay, hey, maybe there's more downside after you see that. And you see some shorts over here might have puked. Okay. So you run it forward a little bit. It's hanging another big buyer. We should go lower because we're not going higher, especially when I say we should go lower. If we get below him, we should dip back lower. That's a better way to say it. And you stand on guard, whether you're analyzing or talking to somebody or managing the trade yourself. You know where the market needs to stay below. So when you ask the question, where do I put my stop? Now you know the answer without some arbitrary 3 ticks above or 4 ticks below. Here's another thing that was interesting. The NASDAQ was helping push us lower to keep you comfortable if you were short, because you want to see the NASDAQ go down, right? If you're short the ES and someone said you want the NASDAQ to go up or down, if they whispered it to you, I'd say down, right? If you're short, someone would say, hey, do you want the NASDAQ to go up or down? I'd say down. All right, so as we scrub forward and forward and forward, a couple things I don't like, and it's not because I already know it comes out of this hole, is that longs are starting to puke, and you get a lot of them that puke. So if I'm not out of this trade, even from up here, I don't care it goes a few more ticks, I can guarantee you I'm out of it in here. And I don't care if it keeps going lower. Good. Keep going lower. But when I see this, a bunch of longs puke right in here, again, these are sell stops. Sell stops are generally used for longs to get out of the long position. When they get out of a long position, they're no longer trying to sell it above. When they're not longer looking to sell it above, it's easier to go above. It's easier to go higher. And if that doesn't get you out, there was another moment. Let me just grab this thing like this. So it starts to come out of this zone. You're still hoping that it goes lower. Let's say you're short in a good spot. You're helping to go lower. You were told, hey, you're kind of in a support area. You went to the bottom. You got longs that puke, so you got to be careful. There might not be as much selling above. Let's take this forward a little bit. You got a green iceberg that comes in, doesn't get completely filled, but the red one that comes in gets filled right away. Appetite for buying, right? So that's another. Should I still hold on to this short? Let's just, I'll give you the benefit of the doubt. You're short from above. You still got money into it. Big buyer comes in, doesn't slip below it. It's staying at or above where he comes in. And then there was a moment right here. I got to go back now. I knew I was going to go forward too fast. There was a moment where the seller came in right here, and it didn't even budge lower. That's reading order flow, not just the order, not just aggression. What does the market do and how quick does it do it in reaction to it? Again, if the girl likes you, she might talk to you. But if she slaps you in the face, she don't like you. The market didn't like this seller. I keep going back and it won't. Here we go. A couple more. Just want to go back to the moment. Take a look at this. Right there. As soon as he come in, aggressive seller, right there, boom, jumps above it. So if you were short from above and you've seen longs puke, that didn't get you out. You've seen a red iceberg get filled right away, that didn't get you out. Then you see a big seller, doesn't go down at all. And now you're like, oh man, this thing came almost all the way back to my great entry. It's like that story where he was a man of faith and the flood killed him. And he goes to heaven. He says, God, I prayed. Why didn't you rescue? Why didn't you save me? He says, save you. I sent you a boat. I sent you a helicopter. You remember that story? The boat came, says, no, save someone else. I believe in God. He'll save me. Climbs to his roof. The floods to his rooftop. Helicopter comes. Save someone else. God will save me. He dies in the flood. And God says, I gave you longs puking, an iceberg cellar that got filled, and a big cellar that couldn't get it to go down. That's step 7. Now, all kidding aside, I wanted to walk through these scenarios. And this is what we go through every day in the room because this is the reinforcement. That's why for me to pick it apart and tell you exactly what each one of these verticals, it's a waste of time. You'll learn. That's the easy part. You'll get that. You'll learn it. Just understand the longs puking. Why is that important? The shorts puking. Why is that important? A big order comes in and can't get it to go the way it should. Why is that important? Then all the questions that people have about this line and that line, they get answered by default. Where should I put my stop? That gets answered by default once you understand what got you in. How do I use, why is it important to watch other markets? Well, do you go and look at other car dealerships when you're trying to value the price of the car you're buying? So it's all what you use to value price. Why aren't you using it when you trade at this level? Again, if the information gods came down, what would you ask them for? The one thing would be other people's positions. The other thing would be, tell me where the stops are. Right, Paul? Paul's an old floor guy. What were the 2 things you'd want? I use a point and figure, and that's all talked about in the, I think we covered that in step 2. The proper periodicity for your charts. I use point and figure, and that's covered. Let's go back to the slides. Actually, let me go through some questions. Large box orders, I think there are 100 or more. So they're big orders of 100 or more. Purple is buy, red is sell. Let me go through some of the previous questions. Wow, I go way up there. Engineering, all right. Time frame of the candles, again, point and figure. 4 is a popular number that I use. Someone asks, I think might have asked, why stuck longs would equal downside. Because longs equal sellers. Remember from the first webinar, if you're long, you become a seller. So does everybody else. HK, I think that question I answered, it's above 100. Good question. What contract size I use to filter 100 or more for the big buyers and sellers? Jack, I think I answered your question about getting out. Oh, it's the setup in Sierra charts. We use Sierra for the visual, but Dave and I have been together for 5 years now, have taken the MBO data from the CME and filter out a lot of the noise to present it this way and find where stops are. The CME doesn't tell us where the stops are, but we worked it out where we're able to. It's not a guess. It's pretty clear that there's sell orders, and especially when they come down in context of the low, like you don't know it's going to be a low of the move, but if the market moves lower and a bunch of sell stops go out, that's where sell stops are, right? Below the market. Let me go through some other questions, and then I got some of the rest of the slide left. Oh, let me show that. Jim, he's a room guy. He's a puke guy. The puke tool is something that you guys be able to see in the room every day, and then some people have it on their charts all day, every day. In fact, we got to change now this link because other people are going to see it. But anyway, the Jim says, take a look at the puke tool now, guys, chasing it. Now the market just closed, but when we see this, when he's done, high probability it jumps up. So he pushes it down, squeezes everybody who's selling it in front of it. And then he's done, and all the shorts are like looking at each other, waiting for the first guy to run to the exits, and it pops. That doesn't happen daily. When it happens, I don't want to say it's like, what's a good analogy, Jim? When it happens, it's like a freebie. Thanks for pointing that out. Paul S. Yes, that's the ES. For those that were asking, it was the S&Ps. Someone said charts are too small. Hopefully you've seen enough to get the point. You don't have to see it as if you're trading it right now, just to understand the concept of big seller, big buyer. And that's not, I don't want to oversimplify it, Jack. When I see a big buyer, big seller, big buyer, I look to sell it. Big seller, I look to buy it. No, there's other things that have to line up based on another market correlation, based on my bias in the first place. You're not going to be successful waiting for a big seller, buy it, big buyer, sell it. But I bet you'd be more successful than anybody else that spends hundreds of hours studying profile. But you got to qualify it a little deeper into that. I like two things. A big buyer, like in here, for example, on this recording. If I was looking to get short in this zone, Jack, and see this big buyer, that in and of itself, oh, what the hell? That in and of itself could get me short. And then I like to see shorts puke. That combination. Does that answer your question, Jack? Was everybody able to see it enough to make sense of it? All right, good. So Kevin asks, shorts puke mean they are now buyers? No. Shorts that puke, okay, means that they're not buyers, that they're no longer buyers. Does that make sense? They don't turn to buyer. When a short pukes, he doesn't turn to a buyer. He is no longer a buyer. When he opens a short, he turns to a buyer. Good question. Glad you asked it. Dorian answered it. Thank you. How do I defer big buyers, sellers? 100 or more. I got the rest of this slide, then we'll come back and answer the rest of the questions, because I think some of the questions will be answered in the rest of the slides with respect to the program. What is it, what it costs, and things like that. Question, are they proprietary indicators or part of Sierra? Proprietary. And what we do is take the MBO data information, order identification information, and turn it into putting it all and presenting it all on here. Now, the big buyers and sellers is something that you can get inside of Sierra, most charting platforms. This iceberg identification, not as specific. Some others might claim to have, be able to show icebergs, but not this specific, because it shows what the guy is showing and how much he's already done. But this stuff right in here, where stops are to show where people are puking, nobody has that. And guess what? You know why nobody has it? Because nobody realizes the importance of it. All right, let's get back to the slides. And bring you guys in as part of the community. Now, this is something I didn't do. Let's present this. This is something I did not do as I went through it, but I'm going to do it right now. When I talked about the steps to execute a trade, in the instances that we gave, create your bias. Today, there were two of them. First, the jobless numbers was weak and we couldn't go down. So at first I was bullish. The second one was an iceberg order that came in and became a magnet, and I was bearish. All right. Step two, look for area of, if you're bearish, let's just say you're bearish. If you're seeing the iceberg, look for an area that could be potential resistance because of a big order that came down or a thin spot. We call them edge zones, but that's step two in the program. Step three is a big buyer. If you're looking to get short, a big buyer that came in like on its way down to the iceberg, big buyer to come in and can't get it to go up. Plus shorts that puke. If you're looking to get short, you want shorts to puke. Shorts that puke pull their buy order below. If they pull their buy order below, there's less buyers below. It's easier to go down. If you're short, you want it to go down, right? So you don't want shorts in the market. You want them to puke. When a big buyer buys the offer and they absorb it, it's like a guy getting punched in the face and he doesn't blink. That's what you want. Not if you're the guy punching, but that's what you want. If it's a big buyer, can't get the market go up. Make sense? 4, how to use properly putting your stops in the right positions based on a lot of that. So you have proper placement so you're not in a popular spot with everybody else. Now you're going to start to be on our side looking for other people, finding where other people put their stops, but proper stop placement and the proper ways to manage your risk. What's important is once you're good at this becomes like by default easier. You don't have to read a book about risk management and 2% of your account. The reason why people suck at managing the risk is they suck taking it. The reason why people stink at managing the risk is because they suck taking it. But that's step 4 in this program. Step number 5 is the psychology. Now, let me explain the psychology better than even some psychologists in trading. There's only one psychologist, maybe two. Steenbarger's maybe the only one that I would say is well worth listening to or reading his books. Bias creation, step one. Qualify it. Pull the trigger. Manage your risk, step four. Psychology or coaching or randomness is why you're fearful. You see the coincidence? There is none. Each one of these steps in executing a trade connects with each step of the education program. All right. I'm going to show you on the website how, number one, all the steps are laid out with the proper content, but also something that's really important. And that is, what did we say yesterday? Start with the damn goal in mind. Remember that? Start with the goal in mind. So take a look at this. This is the website. I just clicked ahead and went into Edge Foundation Step 1. All right. Why did I go into Edge Foundation Step 1? Because I want to show you the goal, the mission statement you start with. Creating a bias that begins to frame and define the way we're looking to interact with the market. It gets into essential questions that not that you're supposed to know the answers to, that could stimulate conversations with people in the community. But the point is, then you watch the videos. There's not a million videos, and you don't have to watch all of them. The point is, you know what you're supposed to get out of it after watching and going through step one. And then you go to step two. There's only 9 topics in step two. You're like, well, Anthony, what am I supposed to get in step two? Learn to take the concepts of order flow and correlations, market relationships, in order to determine the probability of your bias playing out. Be able to qualify a bias. It enables a trader to take trades with more confidence. Step two in the examples I just walked you through was, I don't like to use the word confirmation, but create objectivity that, hey, it's getting close. Ready, it's the aim and ready, aim, fire. That's covered in step two. So when you look at all these videos, and there's not a million of them, but you already know what you expect to get out of it before you start and embark on the videos. Remember yesterday, start with the goal. Common misperceptions of this. You can't take a trade unless all your factors are in place. Have all your ducks in a row. That's a misconception. Here's another thing about this foundation to elite. Here's what's, I think, always been interesting when people are in selling something. First of all, if what you have is good, you're not selling, you're sharing it. That's number one. Number two, the best way to design. Listen, I'm not a guy that knew exactly the best way to lay out education, but having come across the proper way to deliver, you know what dawned on me is that when people have a program, they usually, like, steps 1, 2, and 3 is the foundation, and steps 4, 5, and 6 is the better stuff. That's the elite. That's not the way it is here. The first 5 steps, you get the difference between a foundation and elite is the foundation is the skill, and the elite is the transfer of that skill. So when someone asks, what's the difference between your foundation and elite? It's that. One are the skills, the other are the videos and the content to take that skill and start pulling the trigger. Christian, give me a second and I'll answer your question. How many people are interested in this program on the elite level? The last thing I added here is, this is the way the course, and there's a promotion to this. This is the way the course is designed to understand in the same order you take the trades. Let me say that again. This is the way the course is designed to understand in the same order you take the trades. Now, you might think this next slide, I forgot to animate this pulling the trigger. I didn't. I want it to stand out. And the reason why is I got other stuff that comes in, but the reason why I wanted it to stand out is because without being great at this, everything else is a lot less important. Every step in this is very important, but I guarantee you, everybody's weakness starts and ends with this. You got to build up to make sure you get better and better at this. And generally, people do all the wrong stuff to fix this weakness. I think we all could agree pulling the trigger, getting in and getting out is everybody's weakest point. I've been trading for 25 years. When I'm trading like crap, it's because my execution, my pulling the trigger. And that's when I need to get reset. That's when coaching or a conversation helps get you back on track. But that's why I left that floating there, because that's a lot of people's weakness. It really is. I mean, almost everyone's. So, not to be too repetition, but that's what it's all about. Pounding this in every day in the room. But the ecosystem, the ETG ecosystem that I had and been running this business for five or six, I don't know how many years now. I did a room since 2012, but redesigned it over the last couple months and created what's an ecosystem. So people that have been around me before this last month, there's a lot we added. And it's not just laying out the courses in this way with the goals in mind, but also a Discord room. I'm going to tell you the promotion before I tell you what it is. What you see on the website for the elite is 10% off, but only through Sunday. There's the coupon, 10-2-SUN, 10-TOSUN, right here in bold. Through Sunday. Put that in there, it'll take 10% off. After the first month, so you'll essentially get the first month for free of the room and the Discord channel when you do the elite. What is the elite? Daily trading room. That was the recording I took and went over some examples. Foundation and elite course. When you buy the elite, you get all the foundation videos, of course. And this Discord channel that we brought in. That is about, how old is that now? 2 months? Let me show you what this Discord channel is. And this is the reason why I was told to have a couple testimonials on my website, and I do, but I don't need testimonials on my website because I introduce you to them. They're real people. They're not just someone's first name with a couple quotation marks on how great I am. It's people you're going to get to meet. Take a look at this in our right now in the Discord. I'll pull it across. Here's the posts in our trade setup discussion channel. We have a laugh general chat where people could, let their hair down and have share a laugh. Trade setup room, a chat channel just for elite members. And then here is the most interesting part. If you're an elite member, you get access to all of this plus this right in here. What's this right in here? There's only 3 people in there now because it's 5:00 at night. But this room is filled with probably 15 guys that you click in there and you could talk and listen to them like you're in a virtual prop office. All these guys now, I shouldn't say all of them, there's 7 or 8 that are lifelong friends and they met because of a room like this. We threw it on Discord so that people that are just foundation level also have access to see the posts and everything. The foundation just doesn't have access to talk and listen to other elite members. So that's what I mean about I don't need to create testimonials. You'll meet all these guys. You know what I mean? And so I always have someone put in their first name in the state or the country they're from. There's nothing better than good people, community. If this last year hasn't showed you that, nothing will. But in trading, it's such a lonely business and people search the wrong kind of venues for community. You got to be around people that are like-minded. And the one thing that I've attracted over my years of helping people are guys that have been successful at something else in life. They're not afraid. They know what it takes. They know that they were missing something. So that's 90+% of the people that come to me, guys that have a business, sold a business, or have time to trade and things like that. So those are the people you're putting yourself around. And then when we talk about different puke stuff, we have a channel for that. But this is filled out with elite guys that could talk and listen to each other. And then all the posts that we have. And here's the other thing. The steps that I laid out, creating a bias in the order flow and all what makes price move. I don't tell people, oh, you use profile, get the hell out of here. You use this, whatever this chart, get the hell out of here. No, bring them. If there's something that creates a bias, it includes the stuff I've been talking about, whether you know it or not. But hey, guess what? You take these 5 steps, especially these first 3, and overlay it into where you've been struggling with what you know already. So if you're proficient at profile, don't scrap it. If profile is telling you to buy an LVN and you miss a lot of winners when the LVN works and you catch all the losers, you use this to now qualify it. Because when an LVN works, it's because this stuff is present. When it doesn't work, it's because this stuff wasn't present. Does that make sense to you guys? Now, here's a question I'm going to answer because I get it enough. So I don't ignore questions, and I want to answer this one. And then I'll give you a sense of what it's taken from a prop firm. But give me a second, Anita, and I'll get back. Is that how you pronounce your name? I have trouble pronouncing my own name. I have, yes. The question is, do I have members that trade only CL? For sure, I got guys that trade CL, only CL. Stan, I'm not sure. But I do got guys that trade oil. Less guys trade oil because of how much it's changed since the pandemic. Someone asked about order types, covered in steps 3 and 4. When someone asks about market orders, limit orders, and how they fit into this, great question, Jack. So on the website, Dorian, you want to pop in the links for the elite and then use this discount 10 to Sunday. It expires Sunday at midnight. And promotions in trading is important. Here's why it's important. You don't have to, a lot of times promotion is a selling technique, and it's a selling technique because why? Someone figured out it worked. But here's why it's a better technique for this business. And that is you got to identify the risk of doing something, but also the risk in not doing something. So there isn't just the risk in investing in something. The risk is, what if I would have invested in this? How would that have changed what I do and what I've done? TJ, no. Let me go to this last slide and then clean up any other questions I might have missed. When I got hired, this is why community is so important, but the right community. This guy was the owner of our prop firm in 2000. He was an ex-floor trader. And he said to me, there's a picture of me 10 years ago, so don't laugh. He said to me, what makes you think you're going to make money at this? I think he used the word successful. And I said, because, Dave, I'm putting myself around guys that are doing it. And he says, you got the job. You got the job. It was at the end of the interview, so I knew the question was important. And I said, I didn't know that would be the answer, by the way. I kind of just made it up. He says, hey, he looked at the risk manager and says, you don't have to check his references. He says, you got the job. He says, that's the answer I'm looking for. He says, it's not just the people that are doing it that you're putting yourself around, but also the people that are trying to do it. And it's that push and pull that generates that trajectory. Putting yourself around people that are doing it and trying to do it. And most importantly, with the right tool. Stop trying to cut a steak with a spoon. In fact, most of the education out there isn't even cutting a steak with a spoon. It's like cutting a steak with your elbow. And everything's like that though, right? It's not disparaging other education. Most of the stuff out there, whether it's people selling insurance or cars or blankets, most people stink at what they do. So separate yourself and get around these guys that, I mean, it's generated a really great family atmosphere where you got somewhere and something to open up every morning. And it's this, and it's talking to people, communicating with people, talking about things that aren't about trading, but it's that camaraderie that they can understand what you mean and vice versa. Listen to me in the trading room, have people to go to. That's why an earlier question, how do I get over the skepticism of whether or not this is for me? One thing is finally put yourself in front of the right information. That's the governing principle that makes price move. Here's another. I don't know why I put these extra guys in here. But that's, I remember like it was yesterday, April 24th, 2000. I was hired at the prop firm. Celebrated 20 years last April. And there's nothing better in the world when you're consistent and pulling money out of the market. It sucks when you're in a rut. Don't get me wrong. That's why you got to be around other people that are good people. Don't depend on Twitter, social media, or a forum and think that's a community. If you can't talk to people, then it ain't a community. All right, Jack. Glad you liked them. Hopefully you join in some capacity because there's more risk in not doing things like this than doing them. You're going to get, again, when people talk about order flow, well, this is reading order flow. 101, 102, 103, 104, and everything else. Let me ask you guys a question. How many people would say that this information is unique and they never really heard it before outside of me? That's what years ago when I started hearing that would scratch my head. And Paul, you still here? He's a floor guy that came up through similar background as me. When you came from the floor and understood why price moved, and then when I went to the even that I knew that, it wasn't until I got on the prop firm that I didn't understand why people were looking at the board trading the Dow futures, looking at the S&P, and it was like, wow, because there's a lead lag. It didn't dawn on me. Now, I'm not saying there's a lead lag always in the S&P and the NASDAQ, but sometimes. Here's a really great analogy or a great tool that is another tip you could start using tomorrow. If the NASDAQ looks like this and the S&Ps look like this, there's no information there, right? But if the NASDAQ looks like this and the S&Ps look like this, there's information, right? The ES was doing what the NASDAQ was doing, and then it stopped right there. Generally indicative of weakness. And why? It goes back to our part one in this series. Someone is absorbing all the buying that's coming in, maybe because the NASDAQ is going up, whatever. Someone bigger then all these guys buying are jamming them long. Too many longs, stuck longs equals too many sellers. Too many sellers created the weakness. Other people's positions. So if there's nothing, you can take one thing is stick on this acronym. Other people's positions. Important. It's where the whole game is played. All right, Sabra. Hopefully you join. You're thinking on coming aboard. So Paul, you've been in the business from the floor originally. You would find it strange that nobody understands or not too many people are familiar with people who are shorter buyers, people who are longer sellers, or the value of knowing where stops are. Would you be surprised to know that most people don't know the value of that? And so the point is, if you don't know the value of what's most important to know, how are you going to work towards knowing that? That's why everything that I do to create an edge is down the path, always down the path of how can I find where these damn stops are? Stop hunting. Not stop hunting, stop hunting. Hunt for stops. And it's not just one stop, by the way. So if you have a buy stop up here and the price is down in here, one of them, no, a bunch of them. What's a bunch of buy stops connected to below? Buy limits, right? So if the buy stops gets triggered, click, 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 all these get canceled and it's easier to go down. Those are shorts puking. So a lot of people answered, never heard it before, heard it explained this way, etc. Just I think what could click for you is if the information's came down to give you any piece of data you wanted. Now you know what to ask for. If you know what to ask for, you'll know how to. Now, if you're on those paths, you're on the right path, not the rabbit holes. So I hope you guys join and become part of this group right away. A lot of people are. A lot of people will do a lot of things that they didn't know they were capable of doing when it comes to trading. And that's why you need that community, that accountability. It's like drinking. You didn't think you were capable of doing something stupid. And when you're trading, you're drunk with emotion. So you could be a sane and really smart person, and then you add to a loser, and a one lot S&P position turned into 5 and you lost $3,000. And it's because you didn't have that risk manager that came out and tapped you on the shoulder at minus $500, right? You didn't have that accountability. You didn't have that check and balance. That's so important. Any other questions, guys? The offer is for the elite program, TJ. And let's go back up. Glad you asked. 10%, 10 to Sun is the coupon code for the elite course. Click on the link that's in your chat for more information about it. It includes the elite, obviously includes the foundational videos, which are all these steps, which are the same steps in your trade process. Also, the Discord prop firm room. If you do the elite, first month access is free. If you just want to do the trading room, that's the foundation subscription, includes the room, but it's month to month. Doesn't include the elite course, and it doesn't include the Discord channel of talking to people. You could post and see people's posts, but not in the team room. Again, all three of these videos and recordings will be uploaded and emailed to YouTube. Hey, Richard, I could put a couple together, but there's not at first requirements. It's a good question. Is there a list of software and data requirements? Not requirements. First, I would tell you to get into the program, start watching videos, and then I could give you suggestions on software people like and stuff that's not just from a monetary standpoint, but most people will spend too much with software. So be able to give you a sense of what I use, and you could duplicate what I use. I share my chart books with Sierra users if you're a Sierra user, but I don't want to answer that question like you have to use every piece of software I do. The puke tool and everything else is shared daily in the room on the screen share. The link's not working, he says, Dorian. Hold on, Wayne. What part of the link or the checkout? Oh, yeah. If you click down and click join now is the checkout page. And I'll put that in there as well. Wayne, one link is just to the website. The other link is straight to the checkout page. In fact, that's a good idea. Let me show you guys and walk you through it. This is, obviously, I'm a member of the room. So I have the enter room button. I'm a Puke Tool subscriber. So I have that button and the Edge training button. But if you scroll down, it tells you about the foundation and the elite. And then here's where you get the 10% off of Wayne. So you click that join now button. It takes you to the checkout page. And in that checkout page, you're to enter, not Mickey Mouse. You're to have a coupon, enter 10-2-Sun, then click on the page and it'll adjust this price. Make sense? There it's adjusted. See it? Any questions? Any other questions? Wayne, were you able to get that to work? At least the link? Paul S., so you seen the recording that I did? What I walked you through today? It's like that. Here's another way. Go to our YouTube channel and look at some of the highlight videos. Every one of those videos is a highlight of what we talked about real time in the room. So that's your best. That'll answer your question better than I can. Wayne, it's got to be something on your end because anybody else having a problem with the checkout link? I'm not. Dorian's not. I'll let you know if somebody else is. The only thing I'd suggest is another browser. I just tried it on a couple and it works. Sam, great question. Yes. Is it applicable to stocks? It's applicable to anything that has price attached to it. If you were able to see information when buying a car, it would be applicable for that too. Like if you knew inventory of a dealership getting new cars, and the next day you wait to buy the car the next day because the new cars are like new sellers. New sellers lower the price. So if you had insight onto order flow into a dealership, it would work for that, or plane tickets and everything else. But yeah, I mean, you want to put yourself in a position. For instance, let's say you're looking to trade a stock that had some influence or was influenced by the stock indexes, which they're going to be, right? If you're trading Apple and NASDAQ as an index gets hit hard, Apple is going to get weak, most likely, right? And so you could look at reading the flow and um, indexes to get a good sense on whether or not you should be comfortable in an underlying stock. And if you could read the flow in that underlying stock, and when you see an aggressive buying come in that underlying stock and it couldn't rally, that's a position to get out of a long position you might have. If that stock allowed you to get short and you were bearish, take a shot getting short. All right. So I think while that's a great question, it's all applicable. Another thing in step three, step two, we talk about market relationships, the correlation and how to compare and contrast to find value. So you take a stock and you compare it in a sector with other stocks like that to find if it's strong or weak, right? That in and of itself doesn't give you a spot to get longer short, but it gives you a better bias to say, I don't know if it's weak unless I'm comparing it to something. I don't know if the car I'm buying is a good price unless I'm able to compare it to other dealerships, right? So that's the value, the compare contrast is a big missing part as well to people in this business. Order flow, the right order flow. I know order flow is like a buzzword, and a lot of software has all these numbers that do this, and I show you that, and I show you this. But why? Why does that matter? Why does it matter? Why does it matter if an iceberg is sitting down there and he's done 800 and he's showing 100? Why is that a magnet? Why is it going to go down there? And then where's my best place to get short? That's the ball game. So Paul asks, Paul asks, don't understand the last thing mentioned about canceled buy stops and limit orders. If not canceled buy stops, but if your buy stop gets triggered, it's a buy market order, correct? Do you realize that a buy stop is essentially a buy market order once it trades, once that price trades, correct? So if a buy stop gets elected, that's the word, or triggered, that means it fires in a buy market order. Generally, a buy stop is connected to a buy limit below. This is explained in detail, I think, in step 4. Buy stops are connected to buy limits. So when a buy stop gets triggered and fires off, this order gets canceled. So if a bunch of buy stops get elected, the price generally, if it doesn't follow through, does this and goes right back down. Why? Because a bunch of buy limit orders below got canceled. So you gotta walk yourself through a buy stop. A buy stop is used mostly for people that are short, not physically short. but they're a short position. And they're generally used to get people out, of a short position. Okay. So when a short pukes, is the word we use, that means he's no longer short. If a short is no longer short, he's no longer a buyer below. You trade futures, Paul? Super, right in here. If you go to, let me walk you through it. There's a little green phrase, have a coupon. You got to click that and the field opens. So the coupon code field has to be opened. Let me do it again. I refresh it. You don't see a field for a coupon code unless you click it and then enter it. You see that? Super, just so we're on the same page, you won't see a coupon field. You have to click. You don't see have a coupon? If you don't have a coupon, try to clear your cache. But once you see it, you click on it and the field opens. Back to Paul. Does that make sense to you, Paul, with the buy stops? Did it work, Subra? All right, perfect. All right, so Paul, you trade the S&Ps, right? All right, no, that's fine. I'm going to walk you through it. Because if you're having this question, others are having this question, and it's the buy stop, the short. And again, it's covered in detail in the program, but I'm not going to tell you, do the program, then you learn. I'm going to walk you through it again in here because other people, they should know at least this much. All right. So let me do this. Let me go to a clean page. Buy stop. Do you use buy stops, Paul? And this goes for everybody. Don't answer in the chat, but when you're listening to this on recording, use a buy stop. You don't use stops at all? Right. That's what I mean. Buy stop loss is the same thing. Some people use a buy stop to enter a position, but most use it to get out of a losing position. So you can call it a buy stop loss order. All right. So you use a buy stop to get out of a losing position, correct? And what a buy stop is, when you're using it to cover a position, and generally for a loser, the position is what? A short, right? So if you're short, let's say from X, you're trying to buy it lower, correct? With a buy limit order down in here at your target. Make sense so far? You're short from here. You think price is going to go down. You got a buy limit resting. whether you trade like that or not, most people have a buy limit to cover a short position for a winner. So far, so good. All right. A lot of people use an OCO, which means order, cancel, order. They have a buy limit, which would be a winner if price goes down and fills it. But they're also managing their risk with a buy stop for a loss. It's up there. So let's say price doesn't go your way and it goes up. As soon as the price trades where you have your buy stop order, it fills. Guess what happens to this order down in here? Gets pulled or gets canceled, right? So if a lot of buy stops get filled, a lot of buy limits get canceled. That creates this scenario and this dynamic. Less buyers below. And I didn't mention this in a previous slide, including in the membership, is the daily trading room and the Discord community, but also weekly coaching sessions. So every Tuesday, we start late in January, and every Tuesday at 11 Central, I do a live coaching session for just elite members. But it's recorded and uploaded to a private portal for you to see if you can't catch it live. So when you have questions like these or ongoing questions, not only if you can't, if you have the Discord community to chat with people, me in the trading room, and then these weekly sessions, which are content driven every Tuesday. OCO, Paul, not OCL. OCO means order, cancel, order. All that means is most people, when they put in a buy stop and it gets elected, their buy limit below automatically gets canceled. Whatever order gets filled, the other one gets canceled. Order, cancel, order. So when shorts puke or get stopped out, their corresponding buy limit order gets canceled. So when there's less shorts in the market because they all got stopped out, less shorts equal less buyers below. Is that making sense? Less buyers below is always what you want if you're short. In other words, I want to get short after a bunch of other people get stopped out for their short. So this is a good question. What would you say, how much time it would take for a profitable trader, for a trader to become profitable if he's taking courses with investment daily 2 hours? The best way to answer that is it's not the quantity of time you're spending with general rabbit holes that people go down, because you could then say it's just an indefinite amount of time with most education if it doesn't cover the governing principle. But now that it's quality time, which means the right principles that you're learning, the stuff that we've been covering over the last 3 days, I could only answer that question in respect to, from a prop firm, what the expectation was when new guys were hired. And when new guys were hired, probably I was the 20th guy hired, probably 25 or 30, 5 or 10 guys later, they started hiring people without any experience, didn't know anything about trading. And so the leash that they gave them from a time standpoint So anywhere from 4 or 5 months. And those guys, we didn't necessarily have like a handbook and a course and videos for them. There were daily meetings that they went for an hour or so and discussed the markets, and they were learning the right way or the right information. Um, and so it was set up for them. And they didn't want them to necessarily be knocking out of the park after 4 or 5 months, but they wanted to show that they could take risk and break even. But the right way to ask that question is, do you feel like after even just a couple weeks going through this program, is there some things that click that seem less random? We'll never put a timestamp on like success. If I'm not successful in 4 months, then that's it. You add unnecessary pressure. Let me ask you a question. Do you really enjoy doing this? Take it one step at a time. Not, that's why this is understanding trading by design. Each step you worry about instead of all steps, each step at a time. Paul, did that answer your question though? And I'm glad you asked it, because, and I'm kind of glad you didn't understand, because it just reinforces to me and to everybody that as easy as this is for me, it's not to most of the rest of the world. It further confirms how much of an edge this is if you knew where everybody else's stops were, correct? That's what path you have to be on to help qualify the best locations for your shorts and your longs, and also manage your risk and place your stops. My pleasure, Paul. He says he really appreciates me taking the time to explain, and I'm repeating that because after doing this a long time, I've come to the realization that a lot of people are so passionate about doing this job and they give up too soon because they never gave themselves that right, like, what's the best way to put it? They never gave themselves any chance of doing this, and they didn't realize it. So they think that they failed at it, but they never gave themselves, never had the right tools to cut down a tree or build a deck. They were doing it with spoons and butter knives, and they couldn't understand why the deck wouldn't come out right. And they never had the right tools, and they never got to the governing principle of what actually makes price move. And they gave up through no fault of their own. And they think back and regret that, if I would have done this or that, because they never maybe stumbled upon the right information that was going to give them their best chance. And when I come to the realization that so many people are missing this, it's like, I can't believe that they're missing this. And then I think about 22 years ago, I was missing this. And it reminds me of I wouldn't be here today if my girlfriend, now my wife, told me, stick at it a few more months. I'd hate to see you give up because you really love doing it. She wasn't even my wife, but she said, she had a job. If you need money or whatever, I'll support you. And that time bought me the opportunity not to make money in the pit, but it gave me opportunity that kicked off an introduction to a guy who worked at a prop firm. And then the rest was history. But had I quit when I was going to quit, I'd have never, ever gave myself the best chance at making it. And I would have quit thinking that I couldn't do it. No, it's not that I couldn't do it. Just never had the right tool to strip out randomness. Hopefully that makes sense. Never had that right foundation, that right first step. And people, the most dangerous path you could be on is to think it's the right path, and it's an irrelevant path. But you think it's the right path. Hence a rabbit hole. Sometimes you're on a endless path and you're frustrated, but other times you think you're on the right path and you're on the wrong path. Nobody would dispute that this drives for, nobody should ever dispute that this is why price moves. You could go to another webinar of a guy talking about the greatest moving average cross tool he's ever seen. And you could argue that that's useless and worthless, and there'd be a good debate. Nobody could come and argue that this is what drives price up and down. Now the time and the chance is to, or now the opportunity is to use the tool to highlight and address your weakness once and for all. Pull the trigger and don't feel like it was a good guess when you were right. Subra and anybody else, when you join, there's a thank you page that comes up. In there is links to join the Discord room. And then on the home page, the buttons will appear to join the trading room daily at 8 Central. What kind of success, realistic success, can one expect using this education? It's not just using it, it's using the right education. I've got guys in my team room, the elite, that are making a living and have been for a couple, 3 years using these tools of other people puking before they get long, setting up a correct directional bias. And here's another way to answer that question. What kind of success can one expect using this education? I could say, without this education, you have zero chance. Without understanding how to get in when others just got shook out. Without understanding the value of a crowded trade, which is too many longs and they got to puke before you get long. Without understanding the relationship of one market to another that should keep you uncomfortable in a short. Instead, you're adding to it. Not you, but people who are unfamiliar with compare and contrast. Another piece of education, which is covered in the supplemental videos, Paul, is how to trade economic numbers, not as soon as they come out because the market would have already moved, but drivers and stories that break where you can make your month in a trade. Not that you're trying, but you know how to react. Let me roll up, see if there's any other questions. Paul asks, how long have you been trading for? Here's a good question by Paul again. Size account to realistically survive. When they introduced the micros over a year and a half ago, my answer changed. So I would have said every bit of $5,000 to $10,000 plus in an E-mini account. 10,000 and up in an E-mini account when there was just minis and no micros. When they introduced the micros, I think to start a comfortable $2,000 account, you could open it up and trade with $200, $300, $500. Then you have a real bad day and a nice chunk of that comes away. So it's not what you lose psychologically. It is what you lose, but a lot of people psychologically, $50 is not a lot of money, but if you only got $200 in there, it is, and it shouldn't be. So here's the point of micros. If you got $2,000 with the micro, that's how you're learning with skin in the game, but you can get your ass kicked and still only lose $50. Before the micro, you can get your ass kicked and you had no choice but to trade a one lot in the E-minis and you lose $500. Well, that sucks because that's, I always said, a lot of money isn't based on how much you have, it's how much it could buy. So $500 could buy a lot of things. So whether you got $10 million or $1,000, yeah, $500 means a lot more to a guy who's only got 1,000, but 500, if it could buy a lot, it means a lot. You couldn't trade smaller than one when there was just E-minis and no micros. So you had to be funded of 10 or 15,000. Now that the micros are around, I would say $2,000 because you don't want $50 or $80 to be like, oh, 50% of my account went. No, you have to say, hey, I'm learning this with skin in the game. I shouldn't have lost $50 or $80, but at least you got skin in the game as you're learning. So much better than sim trading. The micros have given people a second chance to do this, but it starts with incorporating the right tools to get long and get short, and get out, create the bias, strip out randomness, be objective. It's not, though. It's not. So Ron says, my trading room setup is intense. What do the traders in your room need? It's not that intense. It's intense the first time you look at it because there's all these things. That's why I don't give a trial to my room, because people are going to ask questions that they're not the right questions. They got to know why something would blink red and it's shorts puking. It's not some, magical, hey, just sell it. Believe me, it's bearish. All this mathematical formula. No, it's red because shorts puked. Well, what does that mean? That means that's good if you're looking to get short. That's good if you're already short. Because less shorts, less buyers. It's easier to go down, and you're short. You want it to go down. So it's not as intense as you might think. It's intense because you haven't went through a couple of videos, and it'll clear up. But guys in the room, to answer your question, generally they're Sierra chart users, some Ninja guys. I'm trying to think what else. Probably 60, 70% Ninja. Some Jigsaw guys and everything else. But the thing with Jigsaw is Peter at Jigsaw's got some good tools, but if you're familiar with Jigsaw, there's just a lot of numbers that are not important. They're just not. It's all about how the numbers result into orders and positions. Paul, he asks, what type of physical setup is necessary to see the charts Noam's needed? I would tell people never to just trade with one monitor. I'd always have 3. Most PCs, you could hook up 3 to 4 monitors and video cards. Do you need a 4 big setup? You don't, but you should always have at least 2 big ones, two 24s. If you go back and listen to any video or YouTube webinar I've done, the concepts never change. They shouldn't change. They're the governing principle. The way to see them, there's always a better way to see the same thing. That's changed. So we've chased after, where are these stops at? So we could see where longs and shorts puke. How can we see big buyers and sellers come in easier without having to look all over? How could we see an iceberg come in all in the same place? We even added 2 lines that show ancillary markets. Not that that's not the what's the word? That's not the there's markets. You can put multiple markets on one chart, but we created where, let me just explain this, not to confuse people, but it's important because it's a relationship. Relationships are important when trying to judge value. If the S&Ps are this line here and the NASDAQ is this line up here, that's not the price of the NASDAQ. We have it as this S&P should be up here based on the ratio and stuff with the spread with the NASDAQ. So we could see in a quick instant that the ES is weaker than the NASDAQ. Why is that important? Because if I'm long this ES and this NASDAQ keeps going up, I'm pissed. It happened to me this morning. I'm long. It won't go. NASDAQ's going. I get out. Good thing, because then the ES went down. Then I'm able to get back in. That was the example I showed you, because big seller came in and an iceberg, got back above an iceberg, and it was a better re-entry. So what was the question? Oh, about the monitor setup. Yeah, you don't need to look like you're with NASA, but you should have more than a postage stamp size monitor. I'm still recording. I'm just letting it go. People that don't want to, there's some interesting questions and I think some answers. So people that continue to listen, I think there's continued value. I like some of the most of the questions I get. I like that. It's really dawned on me when I get the how questions, like people that ask me questions on how to do things. It's not their fault. But when the first question is, where do I, where would you put your stop? No. That's like asking me, where do I put my finger on the trigger? First, let's teach the safety of this gun. Make sure you know how to clear a gun, and make sure you know how to handle a gun, and make sure you know the safety of a gun and the improper way to use a gun. Where to put a stop? It's too sometimes there, sometimes there, sometimes here. And then you start explaining that to someone and it's too confusing. Well, of course it's too confusing. It's almost like you're trying to have the deck built before you knew what a tape measure was. Again, it's not other people's fault. I was in the boat that other people are in, taking the wrong education first. I took a $100 spread course at the CME in 1997. Taught me nothing. I took a $2,000 course back in 1998. So $1998, $2,000. And it was worth every penny. Well, they're not. Here's a question by Paul. Computer speed, internet connection critical? Well, you can't just, you don't have to worry about competing with institution HFTs. We're not. But you can't have an unstable connection that keeps dropping either. We're not high frequency in and out, in and out, in and out, in and out. No. In that case, because we're not doing that. And I don't advise or advocate people doing that. But we're not competing against institutions. I don't want you to think that. They're not competing against us. They're in it for different reasons. We're competing against the guys who don't sign up for a program like mine. We're competing and taking up the money of the revolving doors of people who continue to open an account, blow out, open an account, blow out. We mop that up. We go into corners and sweep up a little bit there and a little bit over there. The institutions are in it for all different kinds of other reasons. Trying to ride the wave. Daniel has been with me for 4 years now, Daniel. He says, this is worth it because it's what you need to know, not what you want to know. He says longer than 4 years, maybe 5 years. It's what you need to know, not what you want to know. It's well put. And Daniel and I had not a contentious conversation 5 years ago. Let me tell the story. It wasn't contentious. What did you say when you got off the phone with me? I'm going to say a swear word. What did you say when you got off the phone with me 5 years ago? Or what'd you think? He's full of shit. He says he's full of shit. And he didn't say I was full of shit like I was lying, but that I was wrong. And what he thought I was full of shit about was he was trading bonds. And I asked him, what do you watch? You watch the S&P? He says, no, I trade the bonds. I says, how about the 10-year or anything else? A little bit, but I trade the bonds. He couldn't understand why I was asking him if we watch another market. I says, Daniel, the reason why I'm thinking that you should be watching another market is the S&Ps relate to the bonds. There's an asset allocation. And I says, he goes, what do you mean asset allocation? Stocks go up, bonds go down, especially in fear, flight to safety. People sell stocks and buy bonds. So if you pull up a chart of the S&P, it'll help you time your bond locations. Sometimes give you the location altogether. Not that there's always a lead lag, but it's the teeter-totter approach, especially in moments of fear. And he says he hung up the phone. He says he's full of shit. He goes home. He looked at his computer. And what did you say? You subscribed the next day. He's been with me for 5 years. I told him to look at bond S&P correlation. And I remember he says, tell me a little bit more about asset allocation. I don't get it. I said, just pretend your house is an asset and it's on fire. So you go and get your expensive watches and jewelry and take those assets to save them and reallocate them in the car. And then I go back for my wife. I told that joke at a seminar. My wife was there. She didn't like it. No, she knew I was joking. But that's asset allocation. And so to know in times of fear, people sell stocks, buy bonds. And then when the fear goes away, they sell bonds, buy stocks. Safe haven into bonds when the shit hits the fan, right? Pandemic, bond prices went up, stock prices went down. Bond prices went down when stock prices rebounded. So correlation between stocks and bonds is important, especially when there's a correlation between stocks and bonds. He says, at night, Daniel, good for you. Super, I think that Dorian gave you that link to click on to get a Discord. There's two things. You got to get a Discord account. It's free. Then you create a username with your email. The other link pops you into our community, and then we assign you credentials, and you're off to the races. Oh, they're in. Did you assign? Yeah. Could you put in the state or country you're from and your first name and last name initial? So little things with community that work. Break the ice. Where are you from? Creates a conversation. You know what's awesome about this community is, like I said, there's 8-9 guys that their families know each other. They become such close friends over the last 4 years, 5 years, all because of me in this community. That's what I'm most proud of. But also this, you go in the team room. I don't give an SHIT if 60, 70% they're talking about something outside of trading. They're building a relationship. That's how a prop firm conversation was. We weren't sitting there like robots. Look at the bonds, they just went up 2 ticks. Look at the S&Ps. No, there's laughter, camaraderie, back to business. Laughter. Look at the NASDAQ, right? Things like that. Take a look at our puke tool. You see this in the room daily, 2.5 hours in the trading room that I host. But I blew this up. What did I say about the market after they popped through the icebergs? After he's done, boom. It's like it's under pressure and you let it go and it pops. This was trickier because it was before and after close and reopen. But when we see this happen in the room, it's like a freebie. I don't want to make it sound too oversimplistic, but it all goes back to the governing principle of what moves price. Big seller comes in, drives everybody short, and then he lets it go, and they all turn to buyers and they pop it. Subra, nice to have you. Am I pronouncing your name correctly? How many other people are thinking or going to join the community? Sounds good. If you got any questions as we go, I'd let this recording roll. Man, it's already 6 o'clock, 2.5 hours. It's a pleasure talking and answering. A lot of people, obviously, the crowds diminish as we go through the night. But those that stuck around, glad you stuck around. Hopefully, you got a ton out of it. Those who say they're going to join, I hope to see you join. Remember, there's risk in doing something. Sometimes there's more risk in not doing it. So don't go lose a bunch of money because you were ill informed by some sort of driver or piece of news or some sort of order flow example we walked through and you were unaware of and you lost the money. And that's why I wish I would have used it to invest in education. Give yourself the best chance to pull money out of the market. It's not an easy business. It's impossible without knowing this like the back of your hand. This whole semblance of order flow and stuck traders. And go search around and look and see nobody else is teaching this. I'm going to stop the recording. Probably should have stopped it a while ago, but there was some good Q&A that came from it.